everyone. Thanks for joining us. We're just going to wait a few more seconds to let everybody get settled in, and then we'll begin our presentation. Thanks for joining us today. If you want to share in the chat section or the question section where you're tuning in from, we'd love to hear it. We're all around the Chicagoland area, so say hi if you are also in the Chicagoland area.
And if someone wants to download Wayne's presentation, there should be a link to do so as well, right? So that they could follow along.
Yes, definitely. It's in the handouts part of your GoToWebinar panel. Easy to download. It's in a PDF version format. All right. Well, we'll begin. Well, hello and welcome to this afternoon's webinar, The Rise of AI and Machine Learning in Growth Stocks, led by Wayne Thorp. Thank you so much for joining us. We're happy to have you all here. My name is Jenna Brashear, and I'll be your host for today. And a few things to go over before we get started. We are excited to delve into our most recent growth investing special report, which explores how AI and machine learning are significantly driving secular growth in different sectors. So Wayne will show you how AAII's growth investing strategy provides a logical, rules-based method for investors to manage market volatility in these areas. And before we begin, I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And like we mentioned earlier, a handout of the presentation will be available under the handout section of your GoToWebinar control panel, and the handout section is located on the right-hand side of your screen. And additionally, a copy of the slides used during today's presentation will be sent to all who attended today. And if you have any questions for our speaker during the event, please submit them using the question section of your GoToWebinar control panel. And then once our presentation concludes, John, our moderator for today, will select a few questions for Wayne to answer. And questions that are not selected for the broadcast will be reviewed and addressed afterwards. And of course, you can always email your questions to members@aai.com. And if you experience any issues with the audio or the video during the webinar, please consult the instructions on how to change your device's settings, or you can consult the GoToWebinar website for support at gotowebinar.com. And just a friendly reminder that this presentation is recorded, and a replay of the webinar will be available later this week on the Growth Investing website, as well as our YouTube channel and aai.com/webinars. And those will also include the links to this presentation's handouts and any resources that we've discussed today. And for new viewers, we always like to offer a little background about our organization. So the American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And with that, I'd like to hand over the presentation to John and Wayne.
Thank you so much, Jenna, and welcome to our presentation today. My name is John Bykowski. I'm president of the American Association of Individual Investors, and doing our presentation here today is Wayne Thorp. Now, Wayne hails from Michigan. I know one of you, actually one of our members here attending this webinar today is from Hendersonville, Michigan. So I'm not sure, Wayne, how close that is to you, but I know everything in Michigan is done on a hand. So I'm sure we'll find out where Wayne is from. Hopefully you'll be able to join in as well. But it's an exciting webinar here today. Wayne has a long history at the American Association of Individual Investors. He is head of research here, and over the years he has helped us launch many products and has really elevated the notion of using foundational tools that are evidence-based, that are helpful for individual investors to actually apply and make use of and understand and help play to our competitive advantage. And today, Wayne is going to be talking about a big area of growth that we've seen in the world recently, and that's the whole impact of generative artificial intelligence, these various kinds of models, machine learning, and how they've changed the world, how they've changed the stock market, and how we as individual investors should consider those types of things. So with that, Wayne, please take it away. And I'm going to fade in the background here along with Jenna, and I'll be watching the questions queue for questions. But with that, Wayne, please go ahead and continue.
Hello, everyone, and welcome to today's webinar. I'm Wayne Thorp, Head of Research and Analysis Products and the Senior Financial Analyst at AAII. I'm excited to be here with you today to talk about artificial intelligence, AI, and machine learning, ML, what they are and how they're shaking up industries. Now, don't worry if you're not familiar with these terms. I'll explain everything in simple terms and show how they're driving long-term growth, not just short-term trends. I'll also introduce you to AAII Growth Investing and how you can use it to analyze AI and ML companies or almost any US listed company you're interested in. But before we dive in, I do want to thank Jenna, our showrunner today, and John, our moderator. Ready to get started? Well, let's go. Over the past year or two, you've probably heard terms like AI, machine learning, and large language models, or LLMs, popping up everywhere. But what do they really mean? Well, artificial intelligence is about machines doing tasks that usually need human intelligence, like understanding language, recognizing patterns, solving problems, and making decisions. Machine learning is a type of AI where machines learn from data instead of being programmed step by step. ML algorithms figure out patterns from the data they're given, and they improve over time. So you can think of AI as the broad concept of machines being smart, while ML is one way to make them smarter by learning from experience. Let's look at some examples of how AI and ML are part of our everyday lives. The closed captions that you see on your screen right now, that's AI at work. Even the image on the title slide of this presentation was generated using the ChatGPT large language model. Virtual assistants like Siri or Alexa, they use AI to understand what you say and help with tasks like setting reminders or playing music. When you shop online, AI recommends products you might like based on your browsing or purchase history. Services like Netflix or Spotify suggest shows or songs you might enjoy thanks to AI. Navigation apps like Google Maps Navigation apps like Google Maps use AI to find the fastest routes based on real-time traffic. Personally, I'm a big fan of Waze, and I learned a long time ago to trust when it suggests a detour. Artificial intelligence and machine learning are all around us, making our lives easier and more personalized every day. AI and ML aren't just transforming our daily lives, though. They're also changing how companies function and grow. Let's talk about two types of growth, secular and cyclical. Secular growth is long-term, steady growth driven by big ongoing trends like new technology or changes in consumer behavior. Cyclical growth, on the other hand, depends on the economy's ups and downs, rising in good times and falling in bad. Secular growth is what you want if you're looking for consistent, sustainable investment opportunities that are less likely to be shaken by economic cycles. So to recap, secular growth is long-term and steady, driven by things like tech advances or demographic changes. It's more likely to keep going even when the economy slows down. Cyclical growth is tied to the business cycle. It's up when the economy is up and down when it's down. So what drives secular growth? Typically, it's a mix of things, including technological advancements like the rise of the internet, artificial intelligence, or renewable energy, demographic changes such as aging populations or urbanization, cultural shifts like the growing focus on sustainability or the move towards digital services, globalization that is expanding trade and investment across borders, and policies and regulations that support specific industries, such as green energy. These factors create steady, long-term growth that are less affected by short-term economic changes. Artificial intelligence and machine learning are key drivers of secular growth because they're constantly pushing innovation and efficiency. Whether it's in healthcare, tech, or another sector, these technologies help companies grow by developing new products, improving customer experiences, and optimizing operations. This kind of continuous improvement is what leads to that reliable long-term growth I've been talking about. Artificial intelligence and machine learning are already making a huge impact in various industries. Here are just a few examples. In the healthcare arena, AI helps with early disease detection and personalized treatment plans. For finance, AI is used for detecting fraud, assessing risks, and offering personalized financial advice. Retail companies employ AI to personalize your shopping experience, from product recommendations to managing inventory levels. Manufacturing firms use AI to improve efficiency, predict maintenance needs, and ensure quality control. These are just a few ways that artificial intelligence and machine learning drive growth across different sectors. When we talk about the benefits of artificial intelligence and machine learning, we can break them down into three areas: scalability, competitive advantage, and innovation. When it comes to scalability, AI and ML allow businesses to grow without needing a lot of much more resources beyond the initial investment. They automate tasks, provide data-driven insights, and help personalize experiences at scale. Companies that lead in AI and ML hold a competitive advantage and can innovate faster, make better decisions, and offer more personalized experiences than their competitors. AI and ML spur innovation that helps businesses discover new opportunities and optimize existing processes, leading to continuous innovation. But like any powerful technology, AI and ML come with risks and challenges. Data privacy and security. Handling large data sets can lead to privacy issues and security breaches, which unfortunately are all too common. There can also be biases, fairness issues, and correctness issues. AI models might unintentionally reflect biases in the data, leading to unfair outcomes. Also, LLM hallucinations refer to instances where a large language model generates text that is factually incorrect, misleading, or completely fabricated, despite sounding plausible. The model might produce statements that aren't grounded in reality, leading to what we call hallucinations. There's also the risk of job displacement. Automation can replace jobs, which might cause social unrest and financial hardships. There's also a high cost associated with AI and ML. Developing and maintaining AI systems is expensive. Major tech companies like Microsoft, Google, Meta, and Amazon are collectively projected to spend over $1 trillion on AI-related investments in the coming years, focusing heavily on AI infrastructure such as data centers and computational resources. There's also regulatory uncertainty. Fast-paced AI development can outpace regulations, creating uncertainty. Lastly, there could also be an over-reliance on technology. Relying too much on AI can be risky if the technology fails or produces errors. These risks highlight the need for careful planning and management when adopting AI and ML technologies. But as investors, we also need to be aware of these risks and how they can impact the growth prospects of sectors and individual companies. As AI and ML continue to evolve, investors should keep an eye on a few trends. We should definitely expect more laws around data privacy and ethical AI. We need to watch how AI spreads to different sectors like healthcare, finance, or energy. It's important to stay updated on the latest advancements in AI and ML. But also keep in mind that companies with access to quality data more than likely will have a competitive advantage. Also, companies that can attract top AI talent are likely to succeed. And companies that prioritize reasonable AI might gain a market advantage as people become more aware of AI ethics. By staying on top of these trends, you as an investor can better assess the risks and opportunities that artificial intelligence and machine learning offer.
So Wayne, as long as kind of reached a little interesting perhaps stopping point, very interesting background on industries and companies that themselves are benefiting from the use of generative AI languages that are trying to, analyze data and spit it out in some way that's useful to you. And again, if anybody has any additional questions, please feel free to mention them now. But one question that came up here is, how do you, as an investor, personally make use of some of these tools to help you in day-to-day investing?
To be honest, when it comes to actual day-to-day investing, I don't use generative AI, LLMs or anything like that too much. I use it extensively on a day-to-day basis. I use ChatGPT almost every day. It helps. I use it to, summarize articles. I use it. I do use it. I was writing an article a week or two ago when I was looking at daily price changes in the S&P 500 dating back to 1928. And I had a spreadsheet with all of that data, and I fed that, attached that spreadsheet to a ChatGPT chat, and put in my prompt for the type of data analysis that I needed. And literally within 20 seconds, it had analyzed, I think it was 40-some thousand individual daily data points, and it spit out the information I was looking for. I'd already done some of that analysis previously. It was an update of the data, and it actually had correctly given me all the results through what I'd done previously. So I felt confident in the information going forward. These aren't infallible. So at this point, I don't have quite the level of comfort when it comes to analyzing individual companies. But that also being said, I use a lot of quant screens, and so I use different tools for that. So I already am using technology to potentially identify investment opportunities, but I haven't sort of taken that big leap in using it in depth for actual investment analysis.
Thank you. And I guess you kind of touched upon this, but it's sort of interesting. The question here is, what sectors are AI in? Asked by Jewel here, but in some ways it's surprising because we've had an odd array of winners this year, even on AI stuff. Everything from power companies to chip companies to micro processor company. If you were to try to say, is there any particular sector you would say is most going to benefit from AI?
I would say, probably goes without saying that the tech industry probably is at the forefront right now of AI, just because they have the expertise, they have the horsepower. I have companies like NVIDIA that are generating the chips that are powering the computers that are actually running these LLMs and doing all of the sort of the horsepower, the engine behind all of this. But it's amazing, it's almost everywhere. On the energy side, they're using AI to monitor the power grid. As I alluded to in the finance side, even if it's not, actual investment analysis, they're using AI to come up with customized investment plans. Banks are using it for fraud detection. In healthcare, I was reading an article the other day. I didn't follow up on it, but I read somewhere that some of the first new antibiotics in decades are being generated again, and those were the structure of those antibiotics were being created exclusively with AI. So it is literally everywhere, and depending on how you look at it, that's a good thing or it's a bad thing, but it is everywhere.
So one last question, I'll let you continue on, but will you be looking at the stock screens for investing or AI, and we'll also be naming any kind of stocks to analyze?
So I won't be using the AI stock screens, but I will be talking about one company that's actually in the special report using the growth investing framework to walk you through the growth investing framework, looking at this company that is the forefront of one area of AI.
Thank you very much. So I'm going to go ahead and fade to the background again. I'll be watching for questions. So if anybody has any questions, please type them in. And then I know you're going to save time at the end for any kind of Q&A, correct?
That is correct, yes.
Okay, thank you.
Thank you, John.
Welcome.
So to help investors find companies with sustainable long-term growth potential, I started researching and developing the AAII Growth Investing strategy a few years ago. It's based on evidence-based investing principles and focuses on finding companies equipped to grow steadily and reliably over time. Two key components of this approach are the AAII Growth Grade and the G-Score, both of which I'll explain shortly. Some studies suggest that growth isn't always a great long-term investment strategy. In the long run, many studies suggest that value is the real winner when it comes to investing styles. Personally, though, I believe that that's because they're looking at growth the wrong way. In the AAII growth investing approach, we focus on identifying companies that can consistently generate growth that doesn't rely on the economic cycle. In other words, companies with strong secular growth potential. It's about finding the right growth stocks, the ones that are reliable and sustainable over the long term. The first step in developing the growth grade was identifying key data points like sales growth, profitability, and cash flow. We look for companies with consistent annual sales growth and reasonable and sustainable long-term revenue growth because sales are the lifeblood of any company. Companies that consistently increase their sales each year score high on our analysis, while companies that have grown too rapidly are less attractive. Companies that can generate positive cash from operations also score highly with the growth grade. Our research shows that companies with consistent annual sales growth tend to outperform those that don't. For example, companies that have increased sales for 5 consecutive years tend to do much better than those that haven't. And that's what this chart here on this slide indicates, is the top performing line, the dark blue line at the very top, shows the performance of companies' portfolios rebalanced on an annual basis of those companies that have seen 5 consecutive years of sales increases. Whereas the green line at the bottom shows the performance of those companies that have had 0 increases in sales over the last 5 years. And as one would hope, the green line represents 0 out of 5, the yellow line 1 out of 5, the orange line 3, 2, 3, the light blue, the gray is 4, and the dark blue is 5. So as you start adding annual increases in revenue for a given company, their performance increases based on our simulated trading. But year over year increases in sales, this consistency is a strong indicator of future success based on our simulated results. We also look at the sustainability of growth by examining the 5-year average annual sales growth. Interestingly, companies with moderate, more sustainable growth levels tend to outperform those with extremely high growth. In fact, our analysis shows that companies with the highest historical growth performed worse than those with the weakest sales growth. And that's what you see here on this chart, that the companies, actually the dark red line at the very bottom, those are the companies that ranked in the top 20% of 5-year growth rates. And again, rebalancing on an annual basis. Whereas the green line, those are the companies that ranked in the 40th to, is it the 40th? I should know. Yes, the 40th to 59th percentiles of 5-year sales growth. So at the extremes, the companies with the highest growth rate actually performed worse than those with the worst 5-year sales growth. So that was a very interesting tell for me. So we decided it's best to look for companies that are in that sweet spot where growth is steady and reliable, not too high, not too low, just right. In some circles, actually, I personally refer that as Goldilocks growth. Cash from operations is another critical factor in the AAII growth investing methodology. This metric shows how much cash a company generates from its core business, which is vital for sustaining growth. Strong cash flows allow a company to reinvest in its business without relying too much on debt. It signifies good financial health and resilience, especially during tough times. Consistency in generating positive cash flow is key. Companies that consistently generate positive cash from operations tend to perform better over time. It's a sign of operational efficiency and good leadership, both of which are crucial to sustained growth. So again, this chart shows the dark blue line across the top shows those companies that have had positive cash from operations over 5 years, where the green line at the very bottom, the worst performance, shows those companies that have had no positive annual cash flow over the last 5 years. So again, our simulated results seem to indicate that positive cash flow, just right long-term growth, as well as year-over-year rising sales are all good indicators of stock performance. To calculate the growth grade, we rank companies based on 3 things: the consistency of annual sales growth, adjusted 5-year sales growth rankings, and consistency of positive annual cash flows. The sum of these ranks is then re-ranked, and the scores are graded from F for the lowest to A for the highest. Our backtesting shows that companies with an A grade for growth outperform others over the long term, giving us confidence that the AAII growth grade is a reliable indicator of a company's long-term growth potential and potential stock performance. And as we had hoped, the top line represents A grades, so rebalancing on an annual basis, those companies that had an A grade, all the way down to the worst performers are those that have an F score, the lowest growth, F grade, having the lowest growth score. Keep in mind that growth stocks often trade at high valuations. This is because investors expect them to grow significantly in the future. This expectation justifies paying a premium now, as these companies typically reinvest their earnings to fuel future growth rather than paying dividends. That's why their valuations tend to be higher than those of more mature, slower growing companies. Now, one of the risks with growth stocks is their high expectations, which can lead to short-term volatility, especially around earnings announcements or when the market is risk averse, as it was in early August and had a little burp yesterday as well. The AAII Growth Investing strategy focuses on identifying quality, sustainable growth companies, and it's important to keep a long-term perspective when investing in these typically high valuation stocks. Here in this slide, we see the value scores of the 20 companies that are currently in the growth investing model portfolio. You can see there's a lot of red, the F indicating that these are the highest valuation stocks in our stock universe. In fact, 3/4 of the stocks currently in the growth investing portfolio have value grades placing them in the most expensive category. But really, this shouldn't be surprising given the track record of sales growth, cash generation, and quality of these companies. A risk of investing in high valuation growth stocks is the concept of reversion to the mean. This means a stock's price and a company's growth tend to return to the historical average over time, especially if that growth is especially high, which is, I think, one of the reasons why we saw that the stocks that have the highest growth rates over 5 years tend to be the worst performers, because the companies cannot sustain that level of growth. And as that growth starts to dry up, that's when the stock price will tend to fall off. For high valuation stocks, a drop in price can happen quickly if growth rates slow down. However, as this slide shows, there are studies out there that show that the longer you hold growth stocks, the less impact valuations have on price performance. You see that with a holding period of 1 year, valuations account for roughly 50% of a stock's performance. And this information is coming from BCG and Morgan Stanley research. This was for a period of 1990 to 2009. So yes, it is a little outdated, but it was for a long period of time. And I feel reasonably confident, actually very confident, that this research still holds. And that seems to be the case from my experience as well. But after about 3 years, revenue growth and profitability become the main drivers of returns. Fortunately, those are 2 cornerstones of the AAII growth investing approach. While our simulated results indicated that the growth grade is a strong indicator, we needed more to build a comprehensive strategy. That's where the G-score comes in. Developed by Professor Partha Manraham, The G-score evaluates stocks based on profitability, stability, and accounting practices. Mohan Ram created it to help separate the winners from the losers among high valuation growth stocks. The G-score uses 8 tests to evaluate the quality of a company's growth prospects. The higher the score, the more likely the company is to maintain its growth in the future. The test focuses on profitability, business and earning stability, and accounting conservatism, key factors that help identify promising growth stocks. When Professor Mohanram's research shows that higher G-scores generate better performance than lower scores, we developed our own version, and we also found that companies with higher G-scores tend to outperform those with lower scores over the long term. It is worth pointing out, though, that we did not have advertising expense data, which is one of the tests used in the G-score. So for our simulation, our G-score was on a 7-point scale, not an 8-point scale. But here we see that the companies with a 7 out of 7 G-score significantly outperformed those with even a 6 out of 7, and then progressively worse over our backtesting period that started at the beginning of 1998 and ran through the middle of 2022. For AAII Growth Investing, I maintain a 20 stock real, question, Joe?
As long as, yeah, but before you get into the criteria, just so
Sure.
that we, a couple of questions here. So we differentiate the G score from the growth grade.
Mm-hmm.
And so the question here that came up was, when you're looking at cash, positive cash, are you looking at, and this is for the growth grade, are you looking at simply positive cash, or are you looking at growth in cash?
Simply positive cash flow on an annual basis.
And so the companies that have a longer history of the positive cash flow, that contributes to a higher growth grade. Is that correct?
That is correct, yes.
Okay, very good. And so is there any, what do you do when the G score is high, but the growth grade is low, when there's a conflict? The member is asking that.
I view the growth grade definitely is backward looking, because you're looking at the history, the year-over-year sales increases, positive cash from operation over the last 5 years, as well as the 5-year sales growth rate. So that's a little bit more backward looking. Professor Mohanram created the G score in anticipation of identifying characteristics of stocks that will have quality growth going forward. So that's actually a good question. I've never, because my analysis, it's always looking at, for the growth investing approach, we want stocks that have both high G scores and high growth grades. So that would be a very interesting analysis as to find out why. Obviously, I have a very different collection of data when you're looking at the growth grade versus the G score. There's not much overlap between the two. So you might just be looking at the right set of factors across two different elements that are giving very conflicting results. But actually, I'm going to make a personal note of that now, and I'll see. That might be a future article for weekly growth investing commentary. So
Thank you.
Thank you for the question.
Can you go back one slide? This will help answer 2 questions the members have.
Yes.
So 2 questions here. Are you doing any kind of adjustments for inflation rate?
No inflation adjustments at all.
Okay. And then the other question is, when you say better performance, what is your definition of performance? Is it stock price? When you say, what is performance here?
Performance, all of the charts that I've shown is the average price performance of the different groups rebalanced on an annual basis. So for this particular chart here, chart on slide 28, on an annual basis, we broke down the stock universe into groupings of G score of 1, 2, 3, 4, 5, 6, 7. Which is interesting. Don't have 0. That's interesting. Never thought about that. But anyway, looked at the groups of stocks that have G scores of 1, G-score of 2. And on an annual basis, we rebalance that. And what we just looking at the average price performance of those groups of stocks on an annual basis from the beginning of 1998 through the middle of 2022.
Thank you. And one more question before you go on to the next section. Member was asking, why did you hide the names of the companies in that valuation grade thing?
Mainly because there are, and rightly or wrongly, we do, I think, have some non-subscribers there. So if nothing else, it's a tease that if you'd like to see what those companies are, feel free to subscribe. But that's don't want to give away too much of the recipe, especially for those that are subscribers.
Okay, but I guess you'll get the names if you get the special report then. Is that what you're saying, or?
Those are the 20 stocks in the portfolio.
Well, with the report, you get access to the.
You get three featured stocks in the special report.
Don't you also get access to the growth investing for 3 months?
Yes. My apologies. Yes, because you get the 3 months of complimentary. Yes, you are correct. So if you sign up for the special report, you'll get the report and the 3 months access to growth investing, where you would be able to see it is not a black box system. We are fully transparent as far as the stocks that are in there and the methodology we use to add and delete stocks.
Okay, and so like, remember we were asking about IBM, they could plug in IBM and they can see that it has a growth grade of C, which is average, and a G-score of 5.
Yes, and actually I'll be talking about a tool that they can use to do just that.
Very good. Well, I'm going to continue on, and I'll be back here taking note of the questions here. Thank you, Wayne.
Thank you. For the AAII Growth Investing, I maintain a 20-stock real money portfolio, following a stringent rules-based system to buy and sell stocks. A company must meet strict criteria, including a high growth grade, a strong G-score, and high quality to be considered for this portfolio. We also look at secondary factors like market capitalization, current filings, and trading volume to ensure up-to-date financial data and sufficient liquidity. We also have clear rules for when to sell a stock from the growth investing portfolio. This helps remove emotion from the decision-making process. If a company's growth grade, G-score, or quality grade drops sufficiently, we remove it from the portfolio. There's no questions asked. If it triggers the rule that we've put in place for that, it is removed from the portfolio. So there's no, what ifs involved in the sell decision. Furthermore, if a company reports a year-over-year decline in sales for 4 straight quarters or negative cash from operations for the trailing 12 months, it's also removed. We also track a stock's relative price strength after hitting a new high since being added to the portfolio. If a stock significantly underperforms the market, it may indicate that our investment thesis was wrong and that it's time for us to look for more promising opportunities. Looking at the AAII Growth Investing portfolio's performance since it began in October of 2022, it was up 62.6% through the end of August of this year. It's outperformed its benchmark, the iShares Core S&P 500 ETF, or IVV, which returned 46.6%, including distributions over that period. For the year, the portfolio is lacking the benchmark 12.9% compared to 19.6% through the end of August. The portfolio is heavily weighted in tech and had some of the big Magnificent Seven stocks in it. So personally, I wasn't surprised when those stocks were hit that the portfolio also underperformed. However, despite the drop in the stock market at the start of August, the portfolio carved out a 4.2% gain for the month, while the benchmark was up 2.4%. Now I'd like to show you how you can use the growth investing framework to analyze companies, focusing on a company leading the way in artificial intelligence and machine learning. The company I'm highlighting today is Intuitive Surgical, ticker ISRG. Intuitive may not be what you would consider an artificial intelligence company. It's a global leader in robotic-assisted surgery and is best known for its Da Vinci surgical system. The company was founded in 1995, and it's revolutionized minimally invasive surgery, combining advanced robotics, computer technology, and high-definition imaging to enhance surgical precision and outcomes. Intuitive Surgical has a strong presence in hospitals worldwide and focuses on continuous innovation, which has contributed to its consistent growth over the years. The Da Vinci Surgical System is a highly advanced robotic platform that incorporates artificial intelligence and machine learning to enhance precision, safety, and efficiency in surgery. AI helps process real-time images, filters out unintended movements, and provides feedback to surgeons. Over time, the system learns from the surgeon's preferences, adapting to their unique style and improving patient outcomes. Intuitive Surgical had a growth grade of A at the end of August, based on its growth score of 85. This placed it in the top 15% of US listed companies that AAII tracks. The company has seen an average annual sales growth of 13.9% over the past 5 years, while posting rising annual revenue in 5 of the last 6 years. The 1 year where it failed to grow revenues was in 2020, when COVID severely limited the number of surgeries taking place. Intuitive has also generated positive cash from operations in each of the last 7 years. Intuitive Surgical also has a strong G-score, passing 6 of the 8 tests. This score reflects the company's profitability, stability, and conservative accounting practices. Now, the company doesn't spend as much on R&D relative to its industry competitors, failing this G-score test. However, when you think about it, it is a leader in robotic surgery, and so it's spending money to improve an existing hardware while other companies are playing catch-up. The other test that it fails, our data provider does not provide advertising expenses for Intuitive Surgical, causing it to fail the advertising intensity G-score. While Intuitive has a respectable G-score of 6, and actually Professor Mohanram says that 6 and higher is good enough when it comes to the G-score, for the growth investing portfolio, a company must have a G-score of at least 7 to be considered. So even though it would qualify based on its growth grade, its G-score would not allow it to qualify for the portfolio. So the question came up how you can analyze individual companies. You can do that with the AAII Growth Analyzer, where you can evaluate nearly 7,000 US listed stocks using the growth investing framework. This tool is available exclusively to growth investing and platinum subscribers. In conclusion, I hope I've shown you how artificial intelligence and machine learning are revolutionizing sectors and companies in creating new opportunities for investors. With the AAII Growth Investing approach, you have a powerful framework for identifying companies with sustainable, long-term growth potential. If you wish to contact me with any questions or comments, feel free to email me at wayne@aaii.com. That's Wayne, W-A-Y-N-E, @aaii.com. But before we open things up to questions, I do want to draw your attention to a special report I created that significantly expands my talk here today. In it, I dive deeper into machine learning and artificial intelligence, its evolution, and its impact on consumers, sectors, and individual companies. I also provide an in-depth analysis of 3 companies where artificial intelligence and machine learning play a significant role in their revenue model using the AAII Growth Investing framework. These companies are Intuitive Surgical, NVIDIA, and Alphabet Google. Now, if you're an AAII Platinum or Growth Investing subscriber, you will have access to this report for free, and we'll actually email you a link to that report later this week. We'll also post the report on the Platinum dashboard under the Reports tab. Now, for those of you who aren't currently a Growth or Platinum subscriber, we are extending our Labor Day weekend sale price to those who attend today. But if you purchase this report for $25 today, you will get a complimentary 3-month trial to AAII Growth Investing. Now, if you visit the URL at the top of the screen, invest.aai.com/growth investing-report, you'll be able to access that special report offer. If you have any questions about the special report or AAII Growth Investing, you can either you feel free to contact member services at members@aai.com if you have questions specific to the special report or signing up for growth investing. But if you have questions regarding the special report as far as its content or the mechanization of growth investing, feel free to reach out to me directly. So thank you for joining me today. Now I'll bring back John, who I see is already with us, for the Q&A session.
Well, thank you, Wayne. If someone just wants to really just get a broad series of investments in AI-focused stocks, you think they should use a ETF, a sector ETF, or should they look at individual stocks? Well, any thoughts there? Pros and cons?
I mean, it depends. Ultimately, it depends on the amount of legwork that the individual wants to do. I did find there are, unfortunately, none come to mind at the moment, of course, but I did find that there are, multiple ETFs out there that are focused on AI and machine learning. So if you're just looking for access to that segment of the economy and the stock market, a active ETF or a very narrowly sliced index fund dealing in that would be probably the way to go. But if you're interested in, picking individual stocks, there are, you could use Stock Investor Pro, you could use the custom stock screener, and be able to do some screening to narrow down companies that are probably being impacted and benefiting from AI and ML. So I would say ultimately it comes down to, if you're just looking for, I just want to, buy something, sort of set it and forget it, then probably a focused ETF is the way to go. But if you're more of a DIYer and looking to do that yourself, then you could do the screening yourself, the analysis. So those are the two paths you could take.
Thank you. Don here was wondering, what are your thoughts on some of the potential cybersecurity risks associated with tools such as ChatGPT?
I mean, there are definitely risks involved. There's multiple risks. As far as the security goes, I think like most things, if you're uploading things for it and sort of adding it to its knowledge base, you might want to be cognizant of the things that you're uploading to it. Obviously, you probably wouldn't be wanting to upload, very personal or critical personal information. So that's one thing. I'd say that so there are certainly risks there. There are risks associated with most things in life, and I think just in the case of AI and ML, it's being cognizant of those risks. I'd say the bigger issue, at least for now, is relying on potentially incorrect information that's being generated by AI. Or if you're a Terminator fan, at any point does it achieve consciousness and take over the world?
Thank you. A lot of companies that are in the AI space are relatively new, and a lot of them have they don't have a long history, and they may be trading at high multiples, current price to earnings and whatnot. How would you recommend that investors assess companies with a shorter history, or these kind of high valuation companies?
I mean, especially with a short, if it's a short history, being able to do in-depth analysis does make it tricky. Compounding that with a high valuation definitely will generate some short-term, a greater potential for short-term volatility. So if you are investing in those types of companies, I would probably suggest making it, obviously I'm not a registered investment advisor, but I would not, I would probably have a relatively small portion of your portfolio invested in that. And you just have to understand too, especially new companies, is that the growth could potentially be that, almost straight up, depending on especially if they have some new technologies or things like that. So just be prepared that the growth might be tremendous, but it was not going to be able to hold that growth over a long period of time. So you probably are looking at least in the potentially a short-term holding situation because the stock might be doing this as the growth is doing this, but a lot of new stage companies don't make it to even mid-stage So these are companies that also require a tremendous amount of monitoring, in my opinion.
Yeah. Well, it's funny, actually, you did one of your charts, Joe, earlier on that you're testing showed that stocks that have the absolute highest historical growth or expected growth often don't do as well long term. That's
Exactly.
not a predictor of short term of long term stock prices. Sometimes they kind of revert back to normal. Otherwise,
Yep.
they would take over the world.
Absolutely.
Um, do you consider a stock's price momentum and stock valuation when it comes to growth investing service?
So the question was, so price momentum or valuation? No to both questions. We have, we have a rules-based filter that spits these companies out, and the rules that we use are not at all based on price momentum or valuation. It is strictly, the three main variables are the growth grade, the G score, and the AAII quality grade.
So I suppose if you're a platinum subscriber, though, you probably could make use of some of the other valuation grades or grades if you wanted to kind of overlay that. Is that
You could try, and you would not get any companies. But yes, you obviously could. I mean, to be fully transparent, given the track record of the companies that are passing our screens, they do have very high expectations because they have performed. They have fundamentally have performed very well over an extended period of time. So this is definitely, the growth investing is not a growth at a reasonable price strategy. So trying to apply any type of valuation overlay with the companies passing this, you might find companies that, aren't too badly overpriced based on our valuation scores. But hopefully, over the long term, again, the research that I showed that the longer your holding period, the less impactful high valuations have on stock performance.
so a question here came up from Wayne. So how often do you anticipate stocks rotating in and out of the overall model portfolio?
So we made our very first trades for the portfolio on October 27th of 2022, and over that period of time, we have sold 4 companies. So I think at one point the holding was, I think, over 20 years. It's probably now fallen to probably 10 years or so. But this is very much a long-term focused portfolio. It's not a trading portfolio. But we're not afraid to sell, and if a stock triggers that any of our sell rules, we will certainly get rid of it. But at this point in time, it's been a relatively low turnover portfolio.
Thank you. Do you use any percentage-based trailing stops?
No, I do not. I take that. I mean, I guess in some ways you could almost consider relative strength from high being a trailing stop. But as far as saying, William O'Neill, if a stock falls 7 or 8%, you get out, nothing like that. The only price momentum variable that we use in the entire portfolio management process for growth investing is the relative strength from high. And, we set that to be extremely liberal as well, that we won't remove a stock from the portfolio until it's underperformed the benchmark by at least 50 percentage points. And that's mainly just, that's kind of the exhaustion gap where, okay, obviously, what we thought was going to happen was very wrong. And it's just an absolute to say, okay, it's time. There are inevitably probably better companies out there, better opportunities, and it's time for us to move on from that particular stock.
Thank you. Would you recommend that someone wanting to get involved in AI or machine learning that they focus in on make that like a separate part of the portfolio, or they make that should be their only focus?
I mean, I believe in the benefits of diversification, so I certainly would not put all of your eggs in the AI ML basket. I would advocate, some level of diversification. This is ultimately it's going to come down to is, your risk aversion. These are going to be, probably relatively volatile over the short term. If you're able to stomach that volatility, great. Something to be aware of. But I would say ultimately the size of that investment in your portfolio is going to be driven by your overall time horizon as well as your risk aversion. But I would say certainly not make it the entirety of your portfolio. Personally.
Thank you. And there's a couple of questions here that have to do with performance. In terms of the performance, the actual performance of the portfolio versus back-tested results. Do you have anything to share with that on that?
So simulated results, and I have to be careful saying that it is simulated, but over our back testing period, I think it was 4 or 5 years, ending early in 2022, we'd outperformed the market by, I think it was like 90 some percentage points over that period. Our goal, our investment objective for the growth investing portfolio is to outperform the benchmark on a 3-year rolling average period. Obviously, we don't have 3 years of experience or track record yet. We're outperforming the market at this point in time. Our outperformance has narrowed over the last couple of months as there's been some rotation amongst the Magnificent Seven and volatility in the more tech-related companies. But it performed well in a simulated environment, which would give us the confidence to move forward with an actual market-traded portfolio.
A couple questions just to clarify. So, are there stocks in the growth investing model portfolio that are not tied towards AI and machine learning?
Oh, absolutely. We have actually our latest addition to the portfolio is Oil Dry Corporation of America, best known for kitty litter. So they might use AI in their production process, but they are very much more of a absorption products company. So definitely there is a technology slant to the portfolio. We own some healthcare companies that I'm sure inevitably are using AI. So if you look at a company, inevitably you're probably going to find where it's using AI in some ways, but this is definitely not an AI machine learning oriented portfolio.
Thank you. And how often is the data updated? For example, the G-score.
We run our data process on a daily basis. So in theory, the growth grades could be changing on a daily basis. But when you look at the data underlying that, all of that data is being updated at most on a quarterly basis. So for an individual company, you wouldn't see a significant change in the G-score outside of on a quarterly basis once its new SEC filings are on file. And for the growth grade, a lot of that data is actually annual data. So you might see it be relatively static with maybe some slight variations and a growth score standpoint month to month, but that you won't see very large swings in the growth grade, more so on an annual basis.
Thank you. Well, that's a interesting question. Would it be a good approach to use both the growth portfolio and the shadow stock portfolio?
I mean, we don't, well, even our market caps, redundant there. No, actually, we do have.
It probably would be very different. I guess they probably have. We probably should run a correlation against the two, although I haven't been around that long. They probably would be complementary. They probably would move differently. One would definitely, the shadow stock being small cap value, would typically probably do a little bit, perform differently versus the growth.
Anecdotally, yes, I use a website where I have all of our, I have SSR groups 1, 2, 3, 4. I have the shadow stock portfolio, DI, VMQ, and I will say, oftentimes you'll see a somewhat disparate performance on a daily basis between the shadow stock and the growth investing portfolio.
I'm not sure if you have this handy, but how diversified is the portfolio by sectors, market cap, et cetera?
I don't have that information right on me, but I know when I did this presentation a while ago, I mean, I would say the portfolio is easily probably 70% technology sector. I mean, definitely heavily weighted towards large and mega cap companies. Oil Dry is, I think, the smallest company in the portfolio, and its market cap might be around maybe 450, 500 million. So this tends to be tech-oriented, large mega cap companies.
Okay, but you don't necessarily seek those out. Just happen to pass the screen or the filters.
We go where the data takes us. Yes, that's not making a conscious decision to invest based on strictly market cap or sector industry.
So, a question here. So, like, if someone sees a stock in the ideas list versus the model portfolio, what's the difference between the two?
So, if with growth investing, we have our 20 stock model portfolio. So that's a real money portfolio. That's when we're quoting performance and everything like that. It's those 20 stocks that are in that model portfolio. But inevitably, there might be stocks that people are looking for additional ideas, and we have then what is called the growth ideas list, which are all of the companies that meet all of the criteria to be considered for the model portfolio. Now, currently, that list is, I think, around 34 or 35 companies. So if we remove a stock from the portfolio, a new buy will come from that ideas list. So these are companies that meet all of the base criteria to be considered for the portfolio, but there's just no guarantee that these stocks will ever end up in the model portfolio. So if you want to buy stocks that are in that growth ideas list, it would be up to you to monitor our deletion rules, which again, this is not a black box system. We offer the explicit buy rules and the explicit sell rules for the portfolio, but it would be up for the individual buying stocks off the ideas list to monitor all of these individual variables to decide when it might be time to move on from it.
And can you? Someone's asking if you could show the link with the to get the report.
Certainly.
They tried to copy it, but they couldn't get it to work. And I guess we're kind of running low on time. Could you have, in terms of pricing, what's the general pricing of the growth investing subscription, and what are the different pricing options?
It is. I should know this. I don't want to give wrong information. I'm sorry, I don't know, and that's terrible of me being head of products. It's drawn a complete blank now. Is it $249 now? I think for an annual subscription. No, it's $299.
Yes, correct, Wayne. It's $249.
$249 for an annual, and then we have typically 1, 2, and 3 year subscriptions. The 3-year often offers a pretty hefty discount, but I do know the 1 year is at $249. But I think if you go to our website, you're able to see all of those. But I do apologize, beyond the $249 for a 1-year subscription, I am drawing a blank at the moment, so apologies.
But it's also part of Platinum then, so if you're a Platinum subscriber, yes, you get access to it as well.
That is correct.
And then does AAII Growth Investing make use of Stock Investor Pro?
No, actually, you say that. We've actually programmed all of our rules on the back end. So the nice thing is, if you go to the ideas list of our website, that's the site that I'm looking at if I need to make any replacements. And actually, like the G-score and the growth grade are not programmed into Stock Investor. So if you were trying to run any screens based on that, you would not be able to do so. So it is all of the data, variables, and tools associated with growth investing are tied directly to its website.
Well, thank you. And there might be a few more questions here, but I guess you're gonna follow up with anybody who signed up for the webinar, and I think we're gonna send out an email with a link to view it again, as well as get access to the slides and whatnot. And I think Jenna's probably gonna do a much better job of explaining all the pattern going forward. But so Jenna, please take it away.
Oh, of course. Well, first off, before we get into all of that, I just wanted to thank John for being such a wonderful moderator today.
Yes.
Thank you for fielding such great questions from the audience. And of course, I want to thank Wayne for guiding us through our annual report for the growth investing, and highlighting all the different the content that we spent a lot of time putting together. So thank you again, both of you.
My pleasure.
And
take care.
And if you have any questions about the special report, as we've mentioned quite a few times earlier in the presentation, or if you have questions about signing up for AAII Growth Investing, feel free to email members@aaii.com. And just a quick reminder again that the report is available for all current growth and platinum subscribers, and a copy will be emailed out later this week, so keep an eye on your inbox. And if you're a platinum subscriber, John mentioned it earlier, but you can access it actually today directly on the platinum dashboard under the reports tab. And if you have any questions or you need help finding where those items are, then just email members@aaii.com. And for those who aren't growth or platinum subscribers yet, we're extending our special Labor Day weekend sale offer to today's attendees. So if you can buy the report for $25 today, and you will receive a complimentary 3-month trial for AAII Growth Investing with your purchase. So you can visit, as Wayne put on the screen right now, and then also I put this in the chat a little bit earlier, but the URL is invest.aai.com/growth-investing-report. To learn more, or you can give us a call at 312-766-8874. And before we sign off, I wanted to mention again that this presentation has been recorded. You'll be able to watch the replay later this week on the Growth Investing website, on aaii.com/webinars, as well as our YouTube channel. And additionally, we always provide the links to the handouts and any resources that we discussed during the presentation on all of those platforms. And with that, we wish all of you viewing good health, good fortune, and a great rest of your day. Thank you, and take care.
Take care.